Friday, August 12th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I'm doing a collaboration video with Alex Pitti from New York. He runs a YouTube channel about the stock markets. So, hi Alex, how are you doing?
Hi, great.
So, what you told me before the interview you want to talk about the debt cycle and Brexit. So, which one should we cover now?
The debt cycle.
The debt cycle, fine. So
I think that a lot of investors and people following the market get a bit caught up on different data points. Like today, we just saw that consumer sentiment came out at 90, and it's you may say, oh, that's pretty decent, but sometimes these indicators can be manipulated, and some of them are like we talked about yesterday, they're survey data and they're not hard data. So I think that when I look at the credit cycle, that's something tangible and it's pretty consistent. There are swings in like different data points like ISM and PMI, producer price index, and so those things aren't a great gauge of the economy. So I look at the credit cycle to see where we're going, and it's pretty consistent. And so what that shows is that we could be ending the cycle and going into recession. And you could look at the default cycle and other indicators. So the average default cycle, I think, is about 3 or something percent. Let me see. I have it.
yeah.
The average is about 3.4%, and right now we're at about 4.6%. So
What
the cycle,
percentage of what? What's that
the
measure?
percentage of that are in default.
Oh, I see. So we're above the average.
Yeah,
For
and
a recession, how much? What is the?
well, it's not necessarily for a recession. It just like it depends on the cycle. In the past few cycles, it's gone up way higher than where we're at now, but it's more like it's been higher at this point than it has been without going into recession. Yeah,
Oh, I see.
so it's never been higher without going into recession.
Yeah.
But it's not close to the peak yet.
Yeah.
We still have a lot more. We're in the beginning. So I've been saying I saw it in a CFA report that we're in the 10th inning of the credit cycle, because it looks like that in February all the federal central bankers got together and they extended it for a little bit longer, which isn't going to help us long term, but it gives them an extra few months to deal with the problems.
So we're in extra innings then.
Yeah. So there's a few predictions. Fitch, one of the ratings agencies, they say that we're going to go into 6%, and then Moody's say 4.4%. So they all have different expectations, but generally they're a little bit higher. The thing is that it's hard to predict these default cycles, and usually they don't just go a little bit higher; they skyrocket towards it's called the stress cycle.
Yeah. So you can't really tell; it just happens all of a sudden.
Yeah.
Yeah.
And then there's four indicators. There's the default rates, and then there's recovery rates, which is the amount that you recover after the bond defaults, and we're actually at record lows in that, and that's partially due to oil, but there's always one sector that does bad.
Yeah.
You can't have X energy, just like you can't have X financials or X technology in the previous cycles. So so the recovery rates would signal we're already in going into a recession. The default rate would be maybe headed towards it. Then the yield spreads is the other point, and that is what I was saying with the February. So it was the average is about 550 basis points. So it went up to about 800 in February, and then the central banks all got together
Is
and
that spread between like treasuries and junk bonds or something?
yeah,
Yeah.
10-year treasuries and high yield bonds.
High yield bonds, yeah.
Yeah, so the reason why we look at high yield bonds is because that's where all the default action
Yeah.
happens.
Yeah.
It's very rare for an investment grade bond to default, but that happened with Lehman Brothers.
Yeah.
So it was about 800 in February, and the central banks all got together February 11th, and they basically put a bottom in the stock market and put a bottom in the yield spreads, and now they're back to average about 550 again, and I think that so even with this indicator, you have to like put it in context and recognize that this isn't just like sometimes there's called a mid-cycle slowing, and then we bounce back. So it happened around 2011, 12, 10 area when like the European crisis was happening.
Yeah.
We had a slowing, and we're seeing with most of the data that we're going worse than that. So this isn't a mid-cycle slowing. It just obvious point
Yeah.
that it's been 7 years the cycle.
And I saw as
So
well that the ECB announced they were going to buy corporate bonds a couple of
yeah,
months ago. That I don't know, they probably didn't buy high yield, but that helps, because if they're
well, yeah.
buying, people have to reach for yield.
Yeah, so yeah, they buy like corporate bonds. I saw that the Spanish 10-year I think went below 1%, which
Yeah.
is insane
Yeah.
because it's not a strong economy. So so they buy the corporate debt, and then the it goes down the ladder into the companies that aren't doing well, and their
Yeah.
yields go down too.
Yeah. The Bank of England as well announced, earlier this month that they're in their QE, they're going to buy gilts, the government paper, but they're also going to start buying corporate bonds. So it looks like they're trying to maintain these spreads artificially.
Yes,
And I
so
don't think it
it's like
lasts.
a never-ending thing. You go from buying the treasuries, and you go down the ladder they're going, and if they end up buying like speculative stocks, I mean, those could obviously go down, and they could really be the bag holder.
Mm.
Um, I have this thing on my computer, but it's not loading. The other point is liquidity risk.
Yeah.
And liquidity is hard to measure. But obviously liquidity caused it caused the last crisis to accelerate as
So can you
liquidity.
explain to the viewers what that is really? Some people.
Well, the liquidity in this case is the ability to for risky companies to raise capital.
Yeah.
Because Heinz Ketchup or Heinz Kraft will always be able to raise money, but
Yeah.
risky company an oil and gas company that has negative cash flow, that company is not going to be able to raise liquidity easily. And junk bonds have done really well since the February crash.
Yeah.
So, but I mean, it's all it's mainly in the oil and gas sector, and it's been weird. And recently, oil prices and then oil stocks and their bonds have decoupled. I mean, oil has gone down like about 20%.
Yeah.
And the stocks have gone up or stayed the same, and their junk bonds have been resilient. It's surprising because I think 2014, I forget who it was, maybe Einhorn said called the mother fracker,
Yeah.
or Pioneer Resources and all of those companies, and he went over how these companies are overvalued. So the stocks all went down, oil prices went down, and then all of a sudden, oil started going up, and it only reached 50. and all these stocks recovered as if like everything was fine.
Yeah.
When it's not even close to fine. The defaults didn't happen. There needs to be more defaults for the whole thing to unwind.
I
On
mean,
zero,
oil now is around 42, isn't it? I mean,
yeah, yeah.
and
So on Zero Hedge, they talked about, which I think was pretty accurate. They said that China wanted to take advantage of these low oil prices, so they filled their strategic reserves. So oil went up from like the 20s to the 50. But these fracking companies can't make money
no,
in
they
the
need
in
to it needs to be above $60 or even 80.
yeah. So
Yeah.
it frustrates me because some of these fracking companies, they say that they make money at 40, but then when you look at their bottom line, they're not really making money. It's because they don't take into account some costs. They say, like one of the bigger companies, EOG, says they make 30% on $40 oil, and then
Mm.
you look, oil was higher this previous quarter, and they lost $293 million because they don't count into all the costs when they say they make money on that price of oil.
It's quite cost heavy, isn't it, fracking?
Yeah, and then also high decline rates,
Yeah.
like quicker than usual. Yeah, so um, these oil companies are always bullish on the price of oil, and they're always drilling.
Yeah.
And the problem is that the more you drill, the lower the price of oil goes. So they're hurting themselves by doing that. So in summary, um, a lot of the credit cycle indicators are showing that we're nearing the end. And when you add in common sense, that it's been about 6.5 years, the average credit cycle is 5.5 years,
Yeah.
and the longest one has been 7 years. So I think that we're trying to compare this cycle to the 1999 like tech bubble, and say, well, why can't this cycle be the longest, and why can't stocks be the most expensive? Now that's bubble talk saying
Yeah.
why can't stocks be even more expensive than
Yeah.
1999 and 2000? There's a small point to that, would be that the Federal Reserve has been manipulating more than then, but then on the other side, the economy was actually pretty strong in the 90s, and it's not strong now. I mean, we have 1% growth,
Yeah.
and I just saw the headline said the IMF is saying the China is gonna go below 6% in 2020. Well, it probably is gonna go faster than that as their entire economy delevers. There isn't much growth in the economy, so it's not looking good,
So
and the
when
Fed
did
is
this
just.
credit cycle start? Like, as per your measures, is that 2011?
It started 6.5 years ago, so
So that just after the crisis, like in
yeah,
'09, after
2000,
'09.
2010.
Yeah. So
Yeah,
it's long in the tooth now.
yeah, it's yeah. So we don't know how long it's gonna last because a lot of times I think like regular investors and people just following it casually, they see people saying that maybe in February things were really bad,
Mm.
and then the stock market went up, and they think that, oh, you just like
Buy the dip.
you lost all credibility because you got it wrong.
Yeah.
But the reality is that it went into extra innings, and they did extraordinary measures, so that just happened. It's like what I'm saying is not like with the Brexit, where like politicians in Europe with the Brexit, they pretty much lie until people saying that the end of the world is going to happen if the
Yeah.
Brexit happened.
Yeah.
That wasn't going to happen. But with this credit cycle, there usually is a recession. You can't predict it with 100% certainty. And then with the Federal Reserve doing all these extraordinary actions, it just extends it. But it doesn't matter too much because, I mean, like if you're like a mutual fund manager, a hedge fund manager, managing money, then you get to keep your job for an extra year. But if you're an everyday person, most people, the economy wasn't great before February. You know,
Yeah, and
the
the thing is,
cycle.
the Fed can try to get the credit cycle continuing, but if the real economy, people, small companies and big companies don't want to borrow, they're not going to be able to create the credit. So I agree. Yeah.
Okay, so that's basically it. So you can subscribe to my channel if you're watching Mario's channel.
Yeah, so if you enjoyed this interview with Alex Pitti, please go to the link below in the description, link to his YouTube channel. He's got interesting things to say, and I really enjoyed the interview with Alex Pitti. So if you'd like to subscribe to my channel, please do, and like this video if you liked it, and share it. And we also accept donations. There are links below in the description: Bitcoin, PayPal, or Patreon. Thanks for watching. Bye.